This question tests understanding of beta symbol, one of the most important concepts in portfolio management, and the capital asset pricing model, CAPM. Beta measures a security's systematic risk, or the degree to which its returns move in response to changes in the overall market. The key point is that beta measures market sensitivity, not total risk. A beta of 1.0 indicates that the investment tends to move in line with the market. A beta greater than 1.0 implies the investment is more volatile than the market, while a beta less than 1.0 indicates lower sensitivity to market movements. A negative beta suggests the investment tends to move in the opposite direction of the market. Students should distinguish beta from standard deviation, which measures total volatility, including both systematic and unsystematic risk. Beta focuses only on the portion of risk that cannot be eliminated through diversification. Choice analysis. A. Variability or standard deviation of the investment returns. Incorrect. Standard deviation measures the total volatility of returns, including company-specific and market risk. It is not the definition of beta. B. Investment return sensitivity to changes in the market's returns. Correct. Beta measures how responsive an investment's return is to changes in the overall market return. It is the standard measure of systematic risk used in CAPM. C. Investment return sensitivity to changes in interest rates. Incorrect. Interest rate sensitivity is more relevant for fixed income securities and duration analysis, not beta. D. Weighted average return of an investment portfolio. Incorrect. This describes portfolio return calculation and has no relation to the definition of beta. Correct answer. B. Investment return sensitivity to changes in the market's returns. Exam tip. Remember that beta measures systematic market risk, while standard deviation measures total risk. In CAPM, beta determines the required return because investors are compensated only for systematic risk that cannot be diversified away. This question tests knowledge of the yield curve, a fundamental concept in fixed income markets and interest rate analysis. The yield curve is a graph that illustrates the relationship between bond yields, interest rates, and their time to maturity, assuming the bonds have similar credit quality. The yield curve is commonly constructed using government securities because they have minimal default risk. It helps investors assess market expectations for future interest rates, inflation, and economic growth. An upward-sloping yield curve indicates that long-term bonds typically offer higher yields than short-term bonds, while an inverted yield curve may signal expectations of economic slowdown. The key concept is that the yield curve compares bonds that differ primarily in maturity, not in credit quality, dividend policy, or face value. Choice analysis. A. Credit risk of the issuer of the bonds. Incorrect. Credit risk affects bond yields, but the traditional yield curve compares bonds with similar credit quality while varying only their maturities. Differences in credit risk produce credit spreads, not the yield curve itself. B. Dividend yield of the issuer of the bonds. Incorrect. Bonds pay interest coupons rather than dividends. Dividend yield is a concept associated with common stocks, making this option irrelevant. C. Par value of the bonds. Incorrect. Par value is the bond's face value and does not determine the shape of the yield curve. Bonds with different par values can have similar yields if other characteristics are the same. D. Years to maturity of the bonds. Correct. The yield curve plots bond yields against their remaining years to maturity, making maturity the defining variable on the horizontal axis. Correct answer. D. Years to maturity of the bonds. Exam tip. Remember that the yield curve represents the term structure of interest rates. It shows how yields vary across different maturities for bonds of comparable credit quality, making it an essential tool for forecasting economic conditions and managing interest rate risk. This question tests knowledge of a call provision, an important feature found in some bond indentures. A bond indenture is the legal agreement between the issuer and bondholders that specifies the bond's terms and conditions, including whether the bond is callable. A call provision gives the issuer, not the investor, the right to repurchase the bonds before their stated maturity date. Issuers typically exercise this option when market interest rates decline, allowing them to refinance existing debt at a lower cost. Because callable bonds expose investors to reinvestment risk, they generally offer a higher coupon rate than otherwise similar non-callable bonds. Students should distinguish a callable bond from a convertible bond, which gives bondholders the option to exchange bonds for common stock. Understanding who holds the option, the issuer or the investor, is essential for answering this question correctly. Choice analysis. A. The issuer to exercise an option to redeem the bonds. Correct. A call provision grants the issuer the right to retire the bonds before maturity, usually at a specified call price, which may include a call premium. B. The bondholder to exchange the bond at no additional cost for common shares. Incorrect. This describes a convertible bond, not a callable bond. C. The bondholder to redeem the bond early by paying a call premium. Incorrect. The issuer initiates the call, and if a premium is paid, it is paid by the issuer to the bondholder, not the reverse. D. The issuer to pay a premium in order to prevent bondholders from redeeming bonds. Incorrect. Bondholders generally cannot redeem callable bonds at their discretion. This statement misinterprets the purpose of a call provision. Correct answer. A. The issuer to exercise an option to redeem the bonds. Exam tip. Remember that callable bonds benefit the issuer, while convertible bonds benefit the investor. If interest rates fall, issuers often call outstanding bonds and refinance at lower rates, creating reinvestment risk for bondholders. This question tests understanding of bond indentures and the protective clauses included in debt agreements. A bond indenture is a legal contract between the bond issuer and bondholders that specifies the rights and obligations of both parties. To protect investors and reduce the risk of default, indentures often include protective clauses, which restrict certain actions of the issuer. These protective clauses are known as covenants. Covenants may be affirmative positive, requiring the issuer to perform certain actions, such as maintaining insurance or providing audited financial statements, or negative restrictive, prohibiting actions such as issuing excessive additional debt, paying excessive dividends, or selling key assets without approval. Understanding the terminology used in bond contracts is important because covenant violations can trigger default provisions or other legal remedies. The question asks students to identify the technical term used for these protective clauses. Choice analysis. A. Provisions. Incorrect. A provision is a general contractual term or condition, while covenants are provisions within an indenture. The specific name for protective clauses is covenants. B. Requirements. Incorrect. Requirements describe obligations in a broad sense, but are not the legal term used for protective clauses in bond indentures. C. Addenda. Incorrect. An addendum is an additional document or amendment attached to a contract. It does not specifically refer to protective clauses in bond agreements. D. Covenants. Correct. Covenants are legally binding promises or restrictions included in bond indentures to protect bondholders by limiting issuer actions or requiring certain financial practices. Correct answer. D. Covenants. Exam tip. In bond financing, covenants are protective clauses designed to safeguard lenders and investors. Positive covenants require certain actions, while negative covenants restrict certain activities. Questions on bond indentures frequently test the distinction between call provisions, sinking funds, conversion features, and covenants, so understanding each term is essential for finance and accounting examinations.